Welcome to Keeping It Real, the largest podcast made by real estate agents and for real estate agents. My name is DJ Paris. I am your guide and host through the show. And today is our series, Learn with a Lender. And we have introducing our new Learn with a Lender co-host. And his name is Austin. I'm going to tell you more about him in just a second. By the way, everybody who is new to the show, we appreciate you being here. Please tell a friend. That's the best way that you can help us continue to grow our podcast here. And we do episodes every week. I think we've done over 730, I believe. So anyway, but I want to talk about lending today. That is why Austin is here. And so if you've ever had a deal that fell apart because of financing, and I bet you have, or worse, maybe even lost a buyer because they thought they couldn't qualify, today's episode is really going to change how you do business. So I want to introduce Austin. He's somebody I trust with my referrals, my clients, my reputation. Austin Clarence is a top producing mortgage loan officer from NEXA Mortgage. And for those who don't know, NEXA is the largest mortgage broker platform in the country. And then here's what that means. Austin isn't locked into one bank's products. He has actually access to over 280 lenders, which means if there's a way to get your buyer approved, he's going to find it. From conventional to FHA to investor strategies like DSCR, construction loans, and 15% down investment property programs, Austin solves the deals that traditional banks decline. He also does traditional stuff too, of course. He's going to be joining us every month for the Learn with a Lender segment. Today, we are kicking it off with something every agent in the market needs to hear. Austin, welcome to Keeping It Real.
Thank you so much for having me, DJ. I appreciate this. Looking forward to teaming up on your podcast. So look forward to just giving some market updates. We can cover so much stuff on this podcast and over the course of the next year or so, with just common objections we're hearing, market updates, everything. If I was a realtor, I would want to know going in just to make you that much more confident going in, having conversations with your buyers and sellers. So appreciate you having me on, DJ. Thank you.
I want everybody to follow Austin on various social channels. He can easily find him. Austin.mortgage is his handle on many different channels. We'll have links to that in the show notes. And I also want you to subscribe to his newsletter. This will really give you great tips and advice about what to do with some of the lending information that's out there as it happens. And that's aclarence@nexalending.com, NEXA. We'll have a link to that. So shoot him a message, tell him you want to get on his email list, and or send him an email, aclarence@nexalending.com. Okay, Austin, let's jump into it. So this was a big last 7 days, or rather, the last 5 days, I think. Last week, Freddie Mac confirmed the 30-year fixed finally hit under 6%, 5.98, I believe. It's the first time we've seen something in the fives since 2022, September of 2022. For agents who have been telling buyers to wait for rates to drop, what does this moment actually mean?
This is huge. We really spent the past 3.5 years praying for rates to drop below 6%. And here we are. We aren't just there now. We're at a 3.5-year low. So this is the moment we've been telling our buyers we've been waiting for. This is the time where savings are going to be massive compared to just a couple years back. So Freddie Mac, like you mentioned, DJ, just last Thursday released that the average national interest rate, 5.98, right? That's the first time we've set an interest rate starting with a 5 since September of 2022. So huge. This is going to be massive psychological impact it has on our buyers, right? That financial threshold that really is going to change everything kind of going into the spring market. So all kinds of momentum right now. There's going to be a little bit of extra volatility in the marketplace. Of course, unless you're living under a rock, you probably heard about the Iran conflict over the past week or so. So this has added a little bit more volatility to interest rates because oil is a huge driver of inflation. Mortgage rates are directly tied to inflation. That's the number one driver for what controls interest rates. So there's going to be a little bit extra volatility. We've seen rates creep up a little bit this week, but the good news is we saw very briefly, DJ, maybe just 24 hours, interest rates starting with a 5. So now we have so much good news to spread on social media, educate our buyers, and then explain the savings of what the payments look like now, what they looked like just a couple years back when we saw rates even creep up to 8%.
Yeah, I remember those days. Went from like sub 3 to 8%, and everyone that had wanted to purchase sort of went, oh, maybe I'll miss my window. And those of us who owned had refied. So it was a tough time for the market. 2023, I remember those days. And the other thing too is I did not know that interest rates were tied to oil prices. That's actually super interesting. And so the Iran conflict, yeah, that is a big deal. So we are seeing a tiny bit of volatility, but it still seems to be pretty low rates despite, what's going on in the Middle East. So basically we have the Fed is pushing rates down on one side, and then the global conflict is kind of raising them on the other. But for the agent sitting across from a buyer this week, how do you frame that tug of war without sort of scaring them off?
I think the best way is just by educating them and showing what a payment would look like now with what it looks like years back, while still comparing the competitiveness of the market, right? We're still in a pretty balanced market favoring buyers in most markets in this country. It's still fairly easy to get that seller concession that 2-1 buy down paid for, almost as easy as what it was just a couple years back when you saw interest rates hit 8%. So I think just putting everything in perspective, showing how much more the savings you're going to have on a monthly basis versus how much that payment would have looked like then, while still showing that it's feasible to get closing costs covered, to get a little bit greedier when you're negotiating that price. And we don't know necessarily if interest rates are going to drop more. There's been so many false flags of a few more months. There's going to be this rate cut. We heard that, DJ, for literally 4 years. The rate cut's right around the corner. And if you held your breath, you wouldn't be looking too good because that ship never really came, and it took years for that first rate cut. So I think really just putting things in perspective, letting know what's feasible in the marketplace, that you can really mainly focus on the down payment, get the closing costs covered, have more negotiation leverage going in, while still have a pretty comfortable monthly payment.
Yeah, I have some numbers on this that you actually provided. I just want to share with the audience today. So 10 months ago, this would be May of 2025, rates were in the sevens. About 7.1 was kind of the 30-year average. And I was looking at like a $500,000 loan, and we were kind of looking to see what the numbers would shift from then until today. And this, I think, really does speak to the education piece, because last year in May, if you would have gotten a loan at 7.1, you'd be paying $33.60 a month. Today, you are paying less. You're paying $639 less. $330 less per month now. So that's basically a savings of $4,000 a year. So anyone that was looking to buy back then, now, to save $4,000 a year is incredible. If they didn't end up purchasing back then, or even somebody like myself who closed at the end of last year, rates were still in the mid sixes. And, I would wish they would come down a little lower for me. I'll have to figure out when I can refi, but those are big drops. So I have one additional question for you about rates, and we can always move on to other things. Is when a buyer tells an agent, hey, rates are still too high, sort of what's the reframe there? Because I know you have a way of flipping that conversation.
Everything is relative. So for them to say the rate is too high rather, what is that relative to? Is that to COVID 2021 when the average interest rate was sub 3%? I think it's good to remind our buyers, let's not be historians. Let's focus on the present and what's available now, because the leverage you have now is pretty similar to what it was 2 years ago when the average rate was 8%. Of course, you're not going to have the buying frenzy of 2021. You're going to have a much more balanced market. Just putting things in perspective, reminding buyers what's on the table now is going to be key in this market.
Yeah, and I have a practical question. So, and this we get asked this a lot in when people reach out to us after these episodes, is especially when rates drop, is should my buyer lock today or should they float? And sort of what's your perspective on that?
And it's a tough call because every day is going to be a little bit different. It's funny you asked that because we had the Iran conflict really started just, I believe it was Saturday morning. We woke up to that news. When I had a buyer, we were kind of looking at some refinance options, and I literally called him Sunday night. I just made a long drive with my fiance. I was like, we got to lock this thing in. Let's go ahead and lock the capital markets that haven't adjusted interest rates yet because it's a weekend. So they still have Fridays. As soon as Monday morning hits, it's going to be a new rate sheet. And rates ended up jumping about an eighth of a percent over pretty much overnight from Friday to Monday's rate sheet. So really just educating them. Every escrow is going to be different. Are you buying a new construction property with a 90-day close? Then you might be able to see rates come back a little bit lower to where they were last week because you can afford to do so with a longer rate lock. If you're doing a quick close, you're going to have to lock in that interest rate in order to send off that closing disclosure that has to go out 3 days before closing. So every transaction is going to be a little bit different. What I try to do, educate the buyer on what's available now. Are there any inflation reports coming out this week? Is the Fed having an announcement this week? What are all the variables that could change? Here's the information, and then ultimately let them make that decision.
Yeah, and also, or just reach out to Austin. He will help you navigate through that with your clients so that you don't have to know exactly what the most current thing to say is based on rates. Austin's obviously the expert. We appreciate you giving him an opportunity on your next buy side deal. I want to talk FHA because this is something that we don't really talk about much on the show, but I think it's important because FHA has a new floor, right? It's like 541,000 basically. So for agents with listings in the mid 500s, what's the pricing strategy they should be thinking about?
Yeah, no, that's a great question because every single year loan limits change. You've probably seen a million loan officers flood your timeline with the new loan limits are out. FHFA changes the loan limits every single year for conventional, and HUD changes it for FHA. So every year it tends to go up 2 to 3% because home prices tend to go up. So loan limits parallel what's happening with home prices. And by the way, that's a great little social proof for our nervous buyers, right? The government is literally raising the loan limits because the data shows home values are continuing to climb, at least on a national basis. So this year we saw a pretty decent jump up, about $21,000 in loan for FHA. So what that really means is if you have, let's say, 3.5% down payment, you can now go up to 541, 287 in 2026. So if you have a listing right at that price point, you might want to price it a little bit higher, a little bit lower to open up the FHA buyers. Because if you're buying with FHA, it's probably because you can't go conventional because of qualifications. And if you have a conventional loan, you probably can't go jumbo because of qualifications, right? So there's always a reason that you are stuck in that loan. So knowing that these loan limits increase is crucial for your listings. I think pricing it strategically based off of this is going to be huge. So make sure to check out your county's loan limit. It can vary a little bit from county to county, but generally 541, 287 is the exact FHA max loan amount. So every year I close at least 2 to 3 transactions where the buyer closes with this loan amount being that exact floor. So this is not like a anomaly where it happens to fall on that floor. This is going to be, it's a pretty common thing is people often just can't go up to conventional because of qualification's sake.
Yeah, I wonder how many buyers this opens up to with this pricing strategy, right? It certainly brings in a lot of the buyers that don't want PMI or that couldn't afford the 20% down with conventional. And, you know, I really never thought about this. So again, just for our listeners, you know, if you have a listing that is in the 550 range or so, 500 range, remember that if you keep it under 541, 287, then that opens up FHA opportunities. And I mean, it's just going to drive a lot more buyers in, I imagine. So that's a really, really smart strategy.
Exactly. I think it can never hurt. Even if you have a $1 million house, look up your county's local loan limits. You can literally just Google FHFA Maricopa County, right? Put your county in there, loan limit. And then if you have a higher price property, jumbos can be really strict and harder to qualify for too. And of course, a jumbo loan is any loan that's $1 above the FHA FA cap, which is basically the conventional loan cap. So knowing these going in, if you're helping buyers or sellers, is crucial because oftentimes those buyers can't make that leap because of qualifications. A jumbo loan, you might have to have 6 to 12 months worth of reserves in the bank, which prevents you from going that route. So you're more limited to conventional. So helping buyers or sellers, it doesn't really matter. Look up your county local loan limits to price all that in going into the transaction, help your sellers, help your buyers too, and then just negotiate that much more strategically.
Yeah, if you guys are finding this valuable, and I know you are, but Austin sends out a weekly intelligence briefing. We talked about this earlier, but I'm going to remind everyone. It really goes even deeper on exactly this kind of information. So email aclarence at nexalending.com. Find him on social media, austin.mortgage. He's everywhere. Asked to be put on this email list so you can get these data points and really sound amazingly experienced and intelligent with respect to lending to your buyers. Okay, and sellers, of course. So let's talk about non-QM and ghost buyers. So QM is maybe something that not all of our listeners know about. So let's define what non-QM is, and then let's talk about it.
Sure. So when you hear the word non-QM, I know a lot of people tend to think, is that a subprime mortgage?
Right.
It's very different, right? So non-qualified mortgage is essentially any loan that's an alternative to a government loan, right? Think USDA, FHA, or a conventional loan. So this could be a DSCR loan, a bank statement loan, a 1099, or even like a no ratio loan. I just helped a buyer close with one of those the other week. So this market has really expanded and doubled in size. I think it's I think it's about 17%, one out of every 6 buyers I saw. I believe it was the Scotsman Guide that had that data point, are now qualifying with a non-QM loan. These loans are really geared for buyers working in the gig economy. So anyone who's self-employed, 1099, they just can't qualify the traditional route with tax returns. So normally lenders are looking at tax returns. Lenders now are not really looking at the tax bill, but the income coming in, right? They're not looking at the traditional way to qualify. And it's not so much a loophole, it's really more institutional infrastructure for the 1099 economy. So let's say, for example, DJ, you are a real estate agent per se, right? So we're only looking at the income going into your bank account and not caring about those debts. We're not going to care about that Bugatti car payment you have or that lease you have at your real estate office. None of those expenses are going to matter. Only looking at those deposits going in. So lenders have really got a lot more comfortable lending on these loans because there's so much data on them. They're performing very strong over the past few years. And so interest rates have actually, the gap has really narrowed from conventional to a non-QM, and they're more attractive than ever. So those payments not going to be that much higher, but the qualification can be so much easier with the alternative way to get qualified with that non-QM feature.
And what's typically the rate difference on a non-QM? Again, I know there's a million variables, but if for someone just to think about, how do non-QMs compare to conventional?
Yeah, great question. And typically, a few factors there, right? The down payment credit score, on average, with a 20% down payment, let's just say today's average rate for conventional is a 6%. For a bank statement loan with strong credit, you're still going to be right around 6.25%, 6.5%,
Wow.
somewhere in that ballpark. So yeah, your payment's going to be a little bit higher, but that loan's not going to have a prepayment penalty. So if your
Right.
income on your tax returns is higher, you can always have an opportunity at some point down the road to refinance. And if the market complies, you'll have some opportunities to get into conventional loans. So this loan's really more of a vehicle just to purchase that property, and you'll have options down the road to refinance out.
That's amazing. I assume the rates would be much higher. Again, I know it depends on credit score and down payment, but these are loans built for people who don't get W-2s, basically. Business owners, contractors, real estate agents, commission earners. And after, these, again, are called cash flow loans, 1099 loans, non-QM. This is a great thing to bring to a buyer. And I suspect not every lending officer has access to these kind of products. So it's amazing that we've never talked about them on the show before in all the years. So non-QM for anybody who doesn't fit in that traditional W-2 mold. And again, as realtors, most of us are 1099, and we know the frustration, or we're S corp people, and we know the frustration of tax returns not reflecting what we actually make, right? So how does a bank statement or a 1099 loan actually work? Like, what do they look for? I guess you were saying cash flow is the main thing.
Yeah, bank statement loans probably one of the more popular non-QM loans. So that's a perfect example. So the lender is either looking at 12 or 24 months income of bank statements. So you literally just upload 12 months of bank statements or 24 months, typically depending on if your rolling average is higher over the past year or over the past couple years. Lenders typically don't really care if it's declining, so you have a little bit of the benefit of the doubt there. So the lender only looking at the deposits going into that account. As long as you can prove that it's your business and it's not a Venmo from your wife, then all that's going to be calculated as income. Lenders typically take a little bit of a haircut. Oftentimes it's 80% of the income or 70% of the income, a little bit of an expense factor. And some of this, it's not going to be a one size fit all. Occasionally a CPA will have to write a letter, but the huge perk is the lender never is looking at the tax returns. So you can get away with minimizing your tax liability and taking every write-off that you have the legal ability to do so, but still being able to qualify for a loan. So many buyers just don't know these programs. The majority of the non-QM loans I do, the buyers literally didn't know this option was out there until
Yeah.
it was presented to them. So a bank or bigger lenders, they often just do not offer any of these programs. I know brokers have more access to the full wholesale channel to find lenders who price out better, who might have more lax guidelines than other lenders. So I think using a broker, typically the best strategy for a non-QM loan because they have that many more options in their disposal. But actually just helped a buyer. It was last spring on a new construction property, and the bank had turned them down. They told them there was no opportunity, there's no way to qualify until they filed their next tax return. And if their income, of course, magically went up by 35%. So the buyer was literally told by an experienced loan officer, there's no other options. And luckily the realtor called me, got me involved, and then we closed about 40 days later. So we'll tell
Um,
you there's no other options, but you have to be creative, work with a broker, and there's probably going to be some options out there that you, the realtor or your buyer, just didn't know even existed.
And this is the reason why we have Austin on the show. He is the most knowledgeable person that I've ever talked to about lending. So really, again, please give him an opportunity on your next loan. Even if it's a backup offer, reach out to him, see what he can do for you. Again, he has access to almost 300 different lending institutions. So every product you can imagine. Well, I want to switch gears and talk about DSCR, which is also a term maybe a lot of our listeners don't know. We're going to I'm just going to quickly explain what it is, and then I'm going to ask Austin to talk about how it relates to a deal he just did. But DSCR is debt service coverage ratio. Sorry, debt service coverage ratio. And let's talk about, this is to do with investors. So you just closed a big deal in Long Beach, right? You had like 2 properties, $1 million total, 15% down. Walk us through how that deal sort of worked with DSCR.
Yeah, so super fortunate the buyer. I think he ended up finding me on YouTube on my YouTube channel, Austin.mortgage. So DSCR loans, my favorite loan, because think about that. You as a realtor, when have you ever had a loan turned down, denied, delayed? It's almost always income verifications, debt to income, car payment, someone gets fired, they make a job change. That's the biggest headache in loans. It's the biggest headache for me. It's the biggest headache for everybody involved. DSCR loans are great because there's zero income. You literally cannot even upload a pay stub or tax returns on your application. The lender's only looking at the fair market rental analysis. So of course, DSCR, this is to acquire a rental property. You can't do it for property you're going to live in. You can't do it as a primary. It has to be for a rental property. You typically need minimum 15% down if you have a strong rental income, or 20% down if not so much. Again, the lender's only looking at the fair market rents based off the appraisal. Appraiser's going to come back with a report called the 1007, and that's going to be the fair market rental analysis. If that rent covers your mortgage payment, you're generally approved based off of that. Of course, you're still going to have to verify the down payment. There's a couple other super small basic factors involved. But really, it's as simple as that. Take the rent, divide that by the full mortgage payment after taxes, insurance, and if an HOA is applied. That's going to give you that DSCR ratio. The lender's ideally looking for a 1 DSCR ratio, and there's really nothing else involved. So that's why it's great, because you can put these offers in without having to worry about income, job changes. There's minimal to no risk. If the property is rented out, you can use that lease. If it's not rented, because most properties are going to be owner occupied or they're going to be vacant, you can have that appraiser go out, use that fair market rental analysis, and then boom, you're good to go. So occasionally if it comes in a little bit low, the fair market rent, there's still options. The interest rate might be a little bit higher, or worst case, you might have to put down a little bit more, but there's so many options out there. These are great loans. And again, it's another one where a lot of investors still don't really understand these programs exist. So we have to get out there, remind our buyers, did you know you can actually purchase another rental property without having to file that 2025 tax return? We don't have to wait for your extension 9 months to qualify. Boom, you can purchase now. There's probably going to be some opportunity to refinance down the road. We don't want to guarantee that. Again, this is a vehicle to purchase that property, do whatever you want with it, have opportunities to refinance later, build equity, and be there to hopefully lock in some appreciation and cash flow.
Yeah, I almost think too, this is a conversation you can have with sellers who or people who own, who maybe want to rent out the property and go, purchase something else, right? You now can do the math on, hey, instead of selling, if you were to, find an investor that wants to buy the property, the numbers work, right? So it almost becomes a conversation, I think, for sellers who never thought of opening that opportunity up. So I think it works sort of both ways, and it really brings an additional sort of just conversation piece you can have even just sort of primary homeowners who are like, hey, by the way, this actually would rent out if you wanted to go that route, and that creates more opportunity for buyers too. So very interesting. I want to get to the real main thing that I think is most exciting to talk about today, but I just want to recap. So we have talked about where rates are at and how they're at a 3.5% low. We have talked about that buying power reset. Also, we've talked about FHA, right? If you keep your listings under 541,287, opens up the opportunity for FHA. We've talked about these non-QM loans, these loans that are not conventional, right? And there's really, the rates aren't that much different. And now I want to talk about this thing that I am not familiar with, but it's a term that you coined called ghost buyers. So I'm so excited because this is a brand new thing that our audience has not heard. But tell us about who ghost buyers are and why they're the biggest untapped pipeline in most agents' databases.
Exactly. And I think many of us listening to this podcast, you were at one point in time a ghost buyer yourself, right? This is the person that can qualify. They just don't know they can. Nobody wants to get turned down for a home loan. It's not fun. I've dealt with denials before, feel dejected. There's oftentimes so much reservation with going through that process of actually applying for that loan. Of course, the first step is to connect with the realtor, as you guys know, and then speak with that lender after that. A lot of buyers just can be a little bit shy. They just don't know they can qualify. They don't want to get denied. And the biggest thing is they just don't have knowledge that these programs exist. They don't know what a bank statement loan is. They don't know what a non-QM loan is. These are programs that are really not nationally advertised. So it's really word of mouth, of course, social media, but speaking with a lender to actually educate on these programs can be the difference between these buyers getting the keys and then renting another year. And who knows if they're ever going to purchase after that. So we talked about my buyer last spring who qualified, who didn't know they can qualify for that bank statement loan. They were turned down. The realtor didn't know there's any options until they called me. They closed 40 days later. There's so many of these buyers out there. They're walking in your open houses. They're your past clients who told you that they have to get that 2025 tax return file that maybe they'll buy next year. They just don't know these programs exist. And that's why we have to just spread the word, let people know there's so many other ways to be qualified as opposed to just showing what's on your tax return.
Yeah. So I want to get really specific with this. So I want to, if best we can, let's come up with a script that an agent could use today if they picked up the phone to call some of these ghost buyers. What should they say?
If I was a realtor picking up the phone, calling these ghost buyers, I would ask them about their situation. What concerns do you have with the qualifying process? Who told you that you wouldn't qualify? Was it a big bank? Big banks are notorious for really not offering these programs. And no offense to any of my friends listening that might work at one of the larger banks in town. They have oftentimes great in-house programs. Non-QM just oftentimes isn't that forte. So finding out, oh, I was just denied by another lender. No, thank you, DJ. I don't want to speak with your lender. Okay, well, who was your lender? Was it a large lender? Was it a large bank? Oftentimes, you're just going to have a higher denial rate as opposed to a broker who just has a larger tools in their arsenal with that massive broker channel. Some lenders only approve non-QM loans. They can do it much more swiftly, easier, which allows you to close on time than another lender. So ask your buyers, who told you that you couldn't qualify? Why couldn't you qualify? What concerns do you have? Is it regarding self-employment, or are you a real estate investor who thinks your debt to income ratio is going to be too high? These are the buyers that I help every single day, and then oftentimes close, get pre-approved, and are initially surprised. And then these are buyers that are going to come back for more. They're going to purchase more properties. And of course, they're always going to remember who referred them to that lender and who got them the keys, which is, of course, you, the buyer's agent.
Yeah, I love that. And again, an amazing thing, because really this idea of ghost buyers. I mean, I was a ghost buyer. It wasn't that I was worried about being denied. I didn't know, this is a long time ago, but I was almost 30 at the time. And I was embarrassed that I didn't really understand how mortgages worked. And so I rented far longer than I should have, but just because I didn't know and I was embarrassed to ask. And I just assumed, well, I don't have this massive down payment to put down. And I thought, well, I just will rent until that's the case. And it wasn't the case. I was able to actually get a conventional loan because I didn't understand, just by reaching out to my realtor, who did have some of this information, but a lot of them don't. And so I think anyone who's renting, this is a great conversation to have with them, is even if today isn't the day that they apply for a loan, putting the bug in their ear and really going through the numbers of, hey, what does building equity look like? We know now that the NAR, I think, just came out with this in the last 6 months, that the average first-time home buyer is now risen to 40 years old, which is really unfortunate. And I mean, it's understandable. We know the middle class is shrinking and purchasing power has changed. And I'm not here to suggest that people who can't do it, should not feel good about themselves. But there's a lot of people choosing not to do it for whatever reason, even though they could. And the problem with it is that they're not going to build it's possible they won't build as much equity in the house, which might help them with retirement. And so I think as agents, we have this huge opportunity right now to have those conversations with renters and just talk to them and run the numbers and say, hey, I've got this guy, Paul. He's gonna reach out and he's gonna find all this great opportunity. I've got Austin, and have him reach out, talk to him, and he'll give you all sorts of options. I think that's like the conversation, right? It's anything that's like, hey, I can qualify. As soon as somebody says that, it's like, talk to Austin. He'll hook you up.
Exactly. And we've been talking a lot about income. That's the most common reason people can't qualify in general. But there's so many other reasons you might not think you can qualify. Could be the down payment. And there could be a program that offers down payment assistance in your county or state, or on a national basis, that'll cover the entire down payment with a grant. You can refinance, sell without ever having to pay back the grant. So it could be down payment. It could be a bankruptcy from a couple years back. It could be credit score. I just pre-approved a buyer that had a 522 credit score the other week, and they didn't think anyone else could do it. They're about to give up, but they didn't. So it's not always going to be income or debt to income, or the income you showed or lack of on your tax returns. It could be down payment. It could be credit score, a bankruptcy on your tax returns from years back. There's a million reasons a buyer could be apprehensive. And it's our job just to remind them that there's so many ways to get creative with financing. And there's so many lenders who would be happy to approve you, as opposed to that first that said they wouldn't.
Yeah, Austin, for any of our listeners who have a deal right now they think is dead, maybe it's a self-employed buyer, somebody who's maxed out their debt to income, or just somebody a bank turned down, which again, I think the majority of buyers are going to traditional banks to get qualified. So what's the first step one of our listeners should take to see if you could save the deal?
Be happy to connect. You guys can reach me a few different ways. Easiest is always email. So my email is just aclarence@nexalending.com. So A Clarence is my last name, CLARENCE at NEXA, which is my company, NEXA lending.com, or NEXA Mortgage. It all goes to the same place. So yeah, shoot me an email. Any questions you guys have, more than happy to connect. If I can't do that particular loan, if it's a unique one that maybe I have a contact I can refer to, or it's a state that I might not be able to operate in, I have contacts everywhere. I just want to be able to help provide some value back to you guys. You can also ping me on social media, Austin NEXA.mortgage. And you can reach out to me with any questions you have via email or, of course, on social media.
Yeah, let's talk about your Thursday newsletter, which is your weekly intelligence briefing, the Thursday drop. So, what's in it, and how can someone get on the list?
We started doing those a few months back, really to offer just a high level briefing of what's happening right now. Is it interest rates? What would I want to know as a realtor in this market? We're going to notate some things happening with market volatility, with interest rate updates, with the loan limit shifts that we were just talking about earlier, and maybe a couple of snippets of the scripts that we're working for ghost buyers to get them off the bench and get them into the game buying real estate. So everything from head to toe is covered. I like to keep it short and sweet. I hate boring newsletters. We're going to keep it concise. We're going to hit the points that you would want to know as a realtor going in to make you that much more prepared for that buyer consultation and that open house you have coming up this Saturday.
I love it. I want everybody to consider giving Austin an opportunity on that next transaction. That's a great way that you can help not just support the show, but support our guest who is so kind. He's coming on every month to deliver value to everyone. And he's a great guy, and he's got access to so many products. He's actually an amazing resource. So give him a shot. Even if you already have a lender that you're currently working with, let him be the backup offer. Let him try to earn a deal in the future. So reach out to him, get on his newsletter list, and find him on social media. We'll have links to all of that in the show notes. And let's talk about next episode, which I know we haven't done yet. And who knows what will change between now and then with rates and news. But without giving away too much, what should agents be paying attention to right now between now and a month from now? Like what should agents notice out in the world?
Yeah, look forward to our next episode. We have a couple different topics lined up that you guys are going to be excited to hear about. But I think when we regroup next month, there's going to be a lot of changes. There's going to be changes with interest rates. We can't control these things. All we can really do is educate our buyers, explain that your payment on this house might look a little bit different unless you go under contract, and we can actually lock in that interest rate. So we can only control what we can't control. All we can do is really educate, explain, make sure our buyers are comfortable with everything, and make sure they're fully confident with the process.
Yeah, love that. And also, we want your questions and comments. Send us your tough clients. Send us your questions about, things that you don't yet understand. We can use those and address those and answer those specifically on future episodes. So, however you're listening to us here, or watching us, just leave us a message in the comments or DM us, or we're easy to find, both Austin and myself. So let us know what you want to hear from us. This is for you. And we appreciate everyone for participating. And I want to really thank Austin for coming on, being our lending partner for Learn with a Lender. He'll be here every month, and we are so excited to be working with him. And he provided so much value in this episode alone. I'm excited for future episodes. So on behalf of our audience, thank you, Austin. On behalf of Austin and myself, thank you to the audience. We appreciate you listening. We appreciate you telling a friend, and we appreciate you giving Austin an opportunity on your next transaction. So please reach out to him, and let's continue to have some fun on the show, learn more, and let us know what you guys want to hear from us. So on behalf of everybody, we will say thank you, goodbye. We will see everybody on the next episode. Thanks, Austin.
Thank you, DJ, for having me on. Thanks, guys.